Hello, everyone, and thank you for being here today. I'm excited to introduce our presentation titled Global Economy Heading for the Next Big Crash, with the subtitle, Is the AI Bubble About to Burst? Today, we'll explore the remarkable rise of artificial intelligence investments, the warning signs that suggest we might be heading toward an economic crisis, and what this could mean for global markets. So, let's dive in and take a closer look at what's happening on this fascinating and potentially pivotal topic. In just a few years, AI has really become a new pillar of the global economy. For example, NVIDIA now holds about 7% of all publicly traded companies in the US, which is quite remarkable. When we look at the stock market, the so-called Magnificent Seven, those major tech giants, make up around 32% of the entire market. That shows just how dominant AI-driven companies have become. And it's not just about the stock market. There's also huge investment flowing into AI. Silicon Valley alone has planned around $400 billion in AI spending in 2025. That level of investment signals how seriously the industry is taking AI's potential. On a broader scale, AI is contributing about 1.1% to the US GDP, which might not sound like a lot at first. But it's significant when you consider the overall economic growth in the first half of 2025. Overall, what we're seeing is that within less than 3 years, companies like OpenAI and NVIDIA have gone from being innovative startups to central players in the global economy. They're shaping market valuations and fueling economic growth in ways we haven't seen before. Let's take a closer look at some of the warning signs coming directly from industry leaders. David Solomon, the CEO of Goldman Sachs, has pointed out that a lot of capital is being deployed into projects that simply don't deliver the expected returns. This suggests that there's a lot of money flowing into ventures that may not be sustainable in the long run. Then we hear from Jeff Bezos, the founder of Amazon, who describes the current situation as an industrial bubble. That's a pretty strong statement, indicating that the market might be overheated and driven more by hype than by actual fundamentals. Sam Altman, the CEO of OpenAI, adds that there's a real risk of overinvestment in AI ventures, which could lead to investors losing money. So even the pioneers and beneficiaries of AI are sounding alarms, warning us to be cautious. And it's not just industry insiders. The Bank of England chair has warned about a potential sudden correction in AI-driven asset valuations. Such a correction could have ripple effects across global financial markets. All these warnings from seasoned financial leaders highlight that, despite the optimism, there's a real recognition that current AI valuations might be precarious. It's essential for us to keep these cautionary signals in mind as we consider the future of AI and its impact on markets. Let's dive into the bubble debate and ask, is AI really different this time? Some argue that the fundamentals are stronger. For example, Federal Reserve Chair Jerome Powell points out that AI firms have more solid earnings compared to the dot-com era, with actual revenue and profit models backing them up. That sounds promising, right? But then we see extreme valuations. NVIDIA, for instance, is trading at around 40 times its forward earnings. Meanwhile, some AI startups are valued at thousands of times their actual revenues. That's a huge discrepancy and raises questions about sustainability. And here's a critical reality check. A study from MIT shows that about 95% of organizations investing in generative AI are currently seeing zero returns. Zero. That's a stark contrast to the hype. Adding to this, we need to consider the massive capital expenditures planned for 2025, over $250 billion. Much of this is financed through complex, circular deals, which can artificially inflate demand and give a misleading picture of how sustainable these investments really are. So, as we look at the overall AI landscape, it's clear that while there are some strong points, there are also significant risks and questions about whether this time really is different. Let's take a moment to look at how past tech crashes can provide us with valuable insights. For example, the dot-com bubble between 1995 and 2000 saw the NISTIC surge by an incredible 573% over just 5 years. This rapid growth was largely fueled by unprofitable startups that didn't yet have clear business models. When the bubble burst, it wiped out trillions of dollars in market value, and the recovery was slow, reshaping the entire tech landscape in the process. Now, fast forward to today's AI surge, which is happening around 2023 to 2025. Nvidia's stock, for instance, rose an astonishing 239% in 2023 alone, and it continued to gain about 171% through 2024. Some major institutions like the IMF and the Bank of England are pointing out how circular deals, where investments seem inflated, are artificially boosting demand. This pattern resembles the euphoria and momentum-driven investing we saw during the dot-com era. Experts are warning us to be cautious. Financial analysts suggest that a potential crash could wipe out as much as $20 trillion in U.S. household wealth. And because markets are more interconnected globally than ever before, the consequences could be even more severe than in 2000. So, understanding these parallels helps us see that while innovation drives progress, we must also be mindful of the risks and the patterns that can lead to bubbles and crashes. Let's take a closer look at the global economic risks associated with an AI bubble burst. The IMF has warned that a collapse of the AI bubble could be one of the top risks to worldwide economic growth. This is especially concerning because the U.S. market is heavily concentrated in AI investments, which creates systemic vulnerabilities, meaning problems here could quickly spread globally. Now, moving to GDP growth dependency. The U.S. economy's growth is increasingly tied to AI-related spending. If this suddenly stops or slows down significantly, it could trigger an immediate recessionary pressure, not just in the U.S., but across interconnected global markets. Next, consider the wealth effect reversal. A lot of consumer spending has been buoyed by gains in AI stocks. If those gains suddenly reverse, we could see a sharp decline in wealth, which would lead consumers to cut back on spending and lose confidence. A double whammy for the economy. Finally, we have amplified vulnerabilities. Factors like ongoing trade tensions, falling house prices in key markets, and historically low savings rates among consumers create a perfect storm. All these elements together could magnify the economic damage if the AI bubble bursts, making the risks even more severe. Connecting all these points, it's clear that an AI bubble collapse isn't just about tech stocks. It's a potential trigger for broader economic instability, which is why it warrants such serious attention. Let's talk about cybersecurity and the geopolitical fractures we're seeing in the AI economy. The AI boom has really fueled the growth of cybersecurity firms, pushing their valuations to extraordinary heights. For example, Palo Alto Networks now has a market cap of around $145 billion. That's incredible, but it also highlights a key concern. Much of this critical infrastructure is concentrated in a few Western firms, mainly from the US and Israel. This raises significant sovereign risk issues because if something happens to these companies, it could impact national security for many countries worldwide. At the same time, governments across Europe, Asia, and emerging markets are responding aggressively. They're pushing policies to diversify supply chains and build digital resilience. Essentially, they're trying to reduce reliance on a small handful of firms and avoid creating strategic vulnerabilities. Regulatory shifts are also on the horizon. New frameworks are emerging that could fundamentally reshape how AI infrastructure is developed, owned, and deployed. These changes might lead to a more fragmented global AI economy, with different regions establishing their own rules and standards along geopolitical lines. So, when we think about market concentration, it's clear that a few Western firms are dominating critical AI infrastructure. This sparks concerns about sovereignty, as nations seek to achieve technological independence and resilience. And finally, regulatory responses are starting to evolve, aiming to govern AI deployment more tightly, which could reshape the entire landscape of AI investment and development. All of these factors are interconnected and highlight the complex geopolitical landscape shaping the future of AI and cybersecurity. Let's take a closer look at the psychology and momentum that drive a bubble. It all starts with rising prices. When prices begin to climb, initial gains attract new investors who are eager for returns. This influx of capital, as more money chases the same assets, pushes valuations even higher. As these gains become more visible, the fear of missing out, what we call FOMO, kicks in. Investors start to feel a sense of urgency, fearing they'll be left behind if they don't jump in now. This creates a feedback loop where the momentum feeds itself, sustaining the rise until some fundamental reality finally intrudes. Interestingly, during this period, volatility can seem deceptively low. It masks the underlying systemic risks that are silently building beneath the surface. Many investors, even if they privately suspect a bubble, continue to invest, hoping they can exit before the inevitable crash. It's a risky game, like musical chairs, but with finances. Historically, tech bubbles and other market bubbles have shown these very patterns. Irrational exuberance followed by sharp, often painful corrections. These corrections tend to catch most participants unprepared, highlighting the importance of understanding these psychological and structural dynamics at play. Let's consider what a potential crash might look like. It could start with an initial market correction, where we see a sharp decline in AI stock valuations. This drop might trigger margin calls and force investors to sell off holdings across the tech sector, amplifying the downward spiral. At the same time, credit conditions could tighten significantly. Financial institutions around the world would likely reduce lending as risk appetite diminishes and concerns about counterparties grow. This reduction in credit availability would make it even harder for businesses and consumers to access funds. As a result, economic activity could slow dramatically. Businesses might freeze investments, employment growth could stall, and consumer spending could contract sharply. This combination of factors can lead to a broader economic slowdown. What really exposes the fragility of the system is how quickly credit-fueled AI investments could unwind. Hidden leverage and interconnected vulnerabilities might surface as investors scramble to liquidate holdings, revealing just how fragile the financial network can be. One critical difference from the 2008 financial crisis is that, this time, the dollar and treasury markets may not serve as safe havens. That means we could see increased global instability, and policymakers might find their options more limited in responding effectively to such a crisis. Overall, this scenario underscores the importance of understanding these interconnected risks and how they could cascade through our financial and economic systems. Let's wrap up with the key takeaway. Navigating the AI boom requires both caution and vision. The path forward is exciting because artificial intelligence has the potential to drive truly transformative economic growth and boost productivity across many sectors. However, we must be mindful of the risks, such as severe market overevaluation and systemic instability that could come with this rapid change. The challenge for all of us, business leaders, investors, and policymakers, is to find that delicate balance. We should be enthusiastic about innovation, but at the same time, practice prudent risk management. Managing expectations about the timelines for returns and the real value of AI investments is crucial. One important strategy is diversification, spreading investments across different sectors and regions. This helps reduce concentration risk and smooths out potential shocks. At the same time, developing regulatory frameworks that encourage innovation while safeguarding systemic stability is essential. We want to foster growth without setting the stage for future crises. Setting realistic expectations is also vital. We need to be disciplined about valuation and avoid getting caught up in hype. While the next big crash isn't inevitable, ignoring warning signs could have catastrophic consequences. So, staying vigilant and balanced will be key as we move forward in this exciting but uncertain landscape.